Hi everybody, this is the gold forecast for August 17th to the 21st. So that's week commencing the 17th to the 21st. So apologies, I didn't have a video last week. This is gold, by the way. I'm using the futures chart. Normally sometimes I use the forex chart, doesn't matter. Now, I still have my levels drawn on. So these are all the auction levels above price and below price. As you can see, we are currently so what is today? Today is Saturday morning. I try and get this out on Fridays, but I've been really busy and it's been really hot. So trying to create videos has been very difficult. So we're currently sitting right now at the 4,400 level or 450-ish, I guess, for 400. And today is Saturday, so this is last week. Um, didn't do anything last week, not in the trade, not looking to trade. Why is that? That's because what I said 2 weeks ago was in my last video. We were here and I said we just need to relax and sit back and let's see what price is going to do because we were consolidating inside this auction level. Okay, and then I said price will move to where? The next auction level, which is right here, this red line. So we have another one above here at 4,600-ish. Then the next one, I've just drawn this is is that 8 or 4,9, 4,8E? Sorry, I don't got my glasses on. Yeah, well, let's say 4,9. And of course, we've got the auction levels below. We've obviously got this one, which we bounced off. And then we've got these blue ones below. So that's 3,900-ish, then 3,800-ish, 850-ish there. And of course, we've got my ultimate target at 3,500. All right. Now, if this is the first video you're watching, don't worry, relax. I'll explain everything. But first, let me just address what I was saying last week, which was, sorry, 2 weeks ago, which is relax. Okay, you don't need to do anything. We just need to just wait. Why? Okay, so last week we had this move, which went above the moving average. What do I use the moving average for? The moving average is a simple tool to determine a bias. You need a bias. You don't have to be correct, but you need a bias. When price is above the moving average, we're bullish. When price is below it, we are bearish. Now, there is a transition, so it isn't automatic. So all I need price to do is prove to me, so show me a confirmation that it doesn't want to go back below the moving average. But technically, I have transitioned from bearish to neutral. And now I'm trying to transition into bullish. Okay, so technically, price is above the moving average. That technically means that my bias will be bullish. Now, it isn't bullish just because this is the first move above it. Okay, so now I needed to show me confirmation, and I'll explain what that looks like. So for next week, I'm doing nothing. I'm just going to see, does price give me confirmation, and it must do this above the moving average. That's it. So next week is neutral. I'm doing nothing. I'm just watching price. Now, is there a possibility I might actually take an entry next week? Very small, but primarily I'm watching price. So for next week, again, sit back and just watch price. Now, what I'm going to do is for the viewers that are watching this for the first time and they have literally no idea what I'm talking about, I'm going to explain everything. Now, this is video number, I think 13 or 14. I've lost count. And I have a lot of videos, but you don't have to watch those videos on the gold forecast. You just need this one particular video. What I do is, in the olden days especially, in order to determine where price was likely to consolidate, I would use touch points. So I just draw a line on a naked chart and look at touch points, and then that's where the line is. Now, why do I draw that line? What's the point of that line? See, as a trader, or as traders, there are two problems we're ultimately trying to solve. Now, there may be more than two, but primarily two. The first one is, where does the trade take place? So I want you to think of this as your location, a location. Once you understand that, your brain transitions to the next part, which is, when does the trade take place? So when does the trade take place? Now that part is dealing with timing, models, etc. So think breakers, think fair value gaps, think demand zones, think VSA, okay? That's the second part. Now, this video only deals with the first part, which is location, right? So my brain or my mindset is focused on only location. Of course, this is always based on a bias. So remember I said, your bias doesn't have to be right. You just need a bias. And neutral is also, you could just be neutral. You stay away from the market. So let me show you how I'm going to kind of view what's happening here. Now, because I am transitioning from bearish to bullish, we have this move which was gone up. That's last week. Today is Saturday. So next week, what am I looking for? First, I have these auction levels. What are auction levels? Again, I explained they're just invisible lines on the chart based on touch points. But I've automated this. I'll show you real quick. I have a tool here. Now, this is internal. It's not external. So it just draws these gray lines. It's very messy. But these lines represent these touch points. It does it automatically. And that's it. Okay. That's all it is. It's just lines on the chart. Now, these lines are very important because what they allow me to do is decide when to enter or exit the trade. So in other words, I only use those levels as entries or exits. I don't do anything anywhere else. So now that you understand the auction level, now I want you to think about that transition of your mindset. Right now, we're currently inside the auction level. So what are we expecting to happen? Price can only do three things at auction levels. It can continue, so continue in the direction that it started. So in this case, it's up, so it just continues going up. But usually it does that after a little break, which we have here. It can reverse, so very strong displacement in the opposite direction, or fair value gaps, that kind of thing, but very strong. And then it can plateau. A plateauing is what you currently kind of see here, okay, where price is just going sideways, or it's churning, or seek and destroy. So it's going to only do one of these three things. If I'm bullish, so let's take price is currently above this moving average. Again, this is based on the daily, and I'm bullish. So what am I expecting to happen? So when price goes into an auction level, I'm expecting price to reverse. Show me aggression, right? Show me aggression. But because I'm bullish, that means I need price to go down into the auction level and then show me the aggression in the opposite direction. Now, you just reverse that if you were bearish, right? Ignore my moving average for 1 second. If you were bearish at any point in time, then you're expecting price to go up and then you take your entry. If you're bullish, you're expecting price to go down and then you take an entry. I know it sounds a bit weird, but that's what you're doing. Now, I can tell you right now that we have this base auction level. Obviously, we have this auction level, but there is also an auction level here in between, which I haven't drawn on because it's a bit messy. And I will use that as a reference point because we are above the moving average. That means I'm going to wait for price to come down into the auction levels around here, and show me a reversal. That's all I want to see. Okay, I want to see a strong move on the daily. then what I will do is go down to a lower time frame, any lower time frame, but above the 1 hour. So 1 hour or above. So it can be 2 hours, 3 hours, for whatever you like. And when price does this reversal, I would look for a retracement to then take a long entry to the next auction level. Why? Because price is simply moving from one auction level to the next one or the next one. Auction levels by themselves have no directional bias. That means when price is at an auction level, it doesn't mean it's bullish or bearish. It's just a level. So I want you to think of auction levels like PD arrays. So they're not PD arrays. So I just want to be clear. It's not a PD array. It's like a PD array. In other words, price moves from one PD array to the next, right? Same for auction levels. Price is simply moving from one auction level to the next one. The only difference is auction levels, again, have no directional bias. So you can't say this is a bullish level or this is a bearish level. That's based on your bias, your own bias. So next week, what I want to see is price go down into this mid auction level, which is around, I would say, the 4,200, 250. I want to see what it does there. Because if it rejects very cleanly off that level up, I may then consider waiting for that retracement to take the entry, take a long entry. But again, it depends on when this happens. If it happens very early in the week, I'm more likely to take it. If it happens later in the week, then I'm just going to wait till next week. Okay, so that's giving you a broad view of how I transition from where a trade is going to happen, location, to when the trade is going to happen. So I just gave you an insight into one of the models I use, which is actually called a two-step model. Okay, it just requires a directional move and a retracement. That's it. It's like an OTE, but it's based off a very old book. It was called a two-step, hence I use the word two-step. So I just give you a little insight into that. Although these videos don't really talk about the second part, just the forecast. So just a quick recap before we end the video. The 3,500 is my 2026 target. Yes, it's below us. Yes, it looks unrealistic, so it may not happen. It's based on all-time high, this low, and then you just project it down from this high right here, and that's a 161 fib level, which is all the way down here. That's all that is. Now that is not the same as the professionals. Goldman Sachs, Merrill Lynch, these guys have their own 2026 target at 5,000 to 6,000 range. So they are very bullish. So there's a mismatch. So I'm not saying I'm correct. I'm not saying I'm wrong. I'm just saying that's just based on my own calculations. But again, what I do is a process. First, establish your bias. The SMA is the simplest thing you can use. Again, you don't have to be correct. You just need a bias. That prevents you from entering trades in the wrong direction of your bias. Once you have the bias, you identify a location. Now, you can use touch points, you can use whatever you want. Again, I use the auction levels. And only then, once you are at a location and you've seen the reaction from that location, do you move to the final step of implementing your trade idea, your strategy, your model based on whatever you have. Okay. So little longer video. That's just because I missed last week. But I'll of course see you next week and I'll try and do it on Friday just to give you time to watch the videos. Again, this is something not clear. You can obviously ask a question and I'll basically address it in the next video. Also, we do have 13 or 14 other videos you can watch. But I'm hoping I've answered every possible question here. So it's not about being right. It's not about being wrong. It's about the process. Have a bias. So establish a bias. Establish a location, step two. And only then are you looking to take a trade in or at that location. That's it. Yes, you can be wrong, and then you're going to get stopped out. But that's it. So next week, hold off a little bit and let's see what price does. If it gives us a bullish entry, then there's a possibility of a bullish entry. And of course, I'll be targeting uh, potentially this level here, which is the 4,600, based on the futures chart. Bullish because we are above the moving average. However, like I said, because this is the first time we've crossed that moving average, you really want to see confirmation, and that confirmation for me is a rejection of the dynamic moving average plus an auction level. So I want to see it come down and then use it as a spring to go back up. If you're incorrect, it will fail and it will break lower, which is fine because that just means you're bearish, right? Because the original bias was bearish. We've been bearish for a long time. This move could just be a simple fake out, right? Just a liquidity grab, right? And we may be going back down. So you don't know what it's going to do. This is why I'm saying you need that bias because the bias prevents you from just entering trade based on price alone. You have a bias. So if you're bullish and price goes bearish, you wait. You're wrong. So you go away and you reassess, right? If you're bearish and price goes bullish, you do the same. But if you're bullish and price is bullish, then bingo, you've got a good trade. All right, guys, thank you very much for watching. I'll see you, of course, in the next video.